Good afternoon. I will begin with one overarching message. We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core prices rose 4.9%. In May, the 12-month change in the Consumer Price Index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food and is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. Participants continue to see risks to inflation as weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Howard Schneider with Reuters. Two related questions. Chair Powell, did you feel you boxed yourself in with the language you used at the last press conference on 50 basis point hikes in June and July? And would you please give us as detailed a sense as you can of what role you played in reshaping market expectations so quickly on Monday?
So, as you know, we always aim to provide as much clarity as we can about our policy intentions, subject to the inherent uncertainty in the economic outlook, because we think monetary policy is more effective when market participants understand how policy will evolve when they understand our objective function, our reaction function. And in the current highly unusual circumstances with inflation well above our goal, we think it's helpful to provide even more clarity than usual, again, subject to uncertainty in the outlook. So, and I think over the course of this year, financial markets have responded and have generally shown that they understand the path we're laying out. Of course, it remains data dependent, and so that's what we generally think about guidance, and that's why we offer it. And of course, when I offered that guidance at the last meeting, I did say that it was subject to the economy performing about in line with expectations. I also said that if the economy if data came in worse than expected, then we would consider moving even more aggressively. So we got the CPI data and also some data on inflation expectations late last week, and we thought for a while, well, this is the appropriate thing to do. So then the question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer is that's not where we are with this. So we decided we needed to go ahead, and so we did. And that's really how we made the decision.
Gina?
Thanks for taking our questions. Gina Smilik with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today. What did 75 achieve that 50 wouldn't have, and why not just go for a full percentage point at some point?
Sure. So if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I mentioned to Howard moments ago. So contrary to expectations, inflation again surprised to the upside. Some indicators of inflation expectations have risen, and projections of this year have moved up notably. So we thought that strong action was warranted at this meeting, and today we delivered that in the form of a 75 basis point rate hike, as I mentioned. So what was the point of it really is this. We've been moving rates up expeditiously to more normal levels. And over the course of the 7 months since we pivoted and began moving in this direction, we've seen financial conditions tighten, and appropriately so. But the federal funds rate, even after this move, is at 1.6%. So again, the committee is moving rates up expeditiously to more normal levels, and we came to the view that we'd like to do a little more front-end loading on that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really about the speed with which you would get there. So as I mentioned, we 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us at the end of the July meeting, in that range in that more normal range, and that's a desirable place to be because you begin to have more optionality there about the speed with which you would proceed going forward. Just talking about the SEP for a second, what it really says is that committee participants widely would like to see policy at a modestly restrictive level at the end of this year. And that's 6 months from now. And so much data and so much can happen. So remember how highly uncertain this is. But so that is generally a range of 3 to 3.5%. That's where people are. And that's what they want to see, knowing what they know now and understanding that we need to show resolve, but also be flexible to incoming data as we see it. If things are better, we don't need to do that much. And if they're not, then we either do that much or possibly even more. But in any case, it will be very data dependent. Then you're looking at next year, and what you're seeing is people see a bit more tightening in a range of maybe 3.5% to 4%. And that's generally what people see as the appropriate path for getting inflation under control and starting back down and then getting back down to 2%. So 75 basis points seem like the right thing to do at this meeting, and And that's what we did.
Steve.
Steve Leisman, CNBC. Thank you for taking my question, Mr. Chairman. You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use often. Now that the committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, the futures market of 4% funds rate next year, do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, could you break that apart for me? How much of that is restrictive, and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Sure. So the question really is, how high does the rate really need to go? And this is, the estimates on the committee are in that range of 3.5% to 4%. And how do you think about that? Well, you can think about the longer run neutral rate. You can compare it to that, and we think that's in the mid twos. You can look, frankly, at broader financial conditions. You can look at, asset prices. You can look at the effect you're having on the economy, rates, asset prices, credit spreads. All of those things go into that. You can also look at the yield curve and ask, all along the yield curve, where is the policy rate? So for much of the yield curve now, real rates are positive. That's not true at the short end. At the short end of the yield curve in the early years, you don't have you have negative rates still. So that really is one data point. It's one part of financial conditions. So I think I have to look at it this way. We move the policy rate, that affects financial conditions, and that affects the economy. We have, of course, rigorous ways to think about it, but ultimately it comes down to, do we think financial conditions are in a place where they're having the desired effect on the economy? And that desired effect is, we'd like to see, demand moderating. Demand is very hot still in the economy. We'd like to see the labor market getting better in balance between supply and demand, and that can happen both from supply and demand. Right now, demand is substantially higher than available supply, though. So we feel that there's a role for us in moderating demand. Those are the things we can affect with our policy tools. There are many things we can't affect, and those would be, the things, the commodity price issues that we're having around the world due to the war in Ukraine and the fallout from that, and also just all of the supply side things that are still, pushing upward on inflation. So that's really how I would think about it.
But does 3.8%, 4% get it done? Does it get the job done of breaking the back of inflation?
I think it's certainly in the range of plausible numbers. I think we'll know when we get there, really. I mean, honestly, that would be, you would have positive real rates, I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days. So I would think it would, but you know what? We're going to find that out empirically. We're not going to be completely model-driven about this. We're going to be looking at this, keeping our eyes open and reacting to incoming data, both on financial conditions and on what's happening in the economy.
Thanks. Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that you like your policy to work through expectations, and now obviously this decision was something quite different from how you and almost all of your colleagues had set those expectations during the intermeeting period. And I know you just said that what changed was really the inflation data, the inflation expectations data, but I'm wondering, on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized before?
So if you look at we look at a broad range of inflation expectations. So you've got the public, you've got surveys of the public and of experts, and you've also got market-based. And I think if you look across that broad range of data, what you see is that expectations are still in the place, very much in the place, where short-term inflation is going to be high, but comes down sharply over the next couple of years. That's really where inflation expectations are. And also, as you get away from this episode, they get back down close to 2%. And so this is really very important to us that remain the case. And I think if you look for most measures, most of the time, that's what you see. even if we even see a couple of indicators that bring that into question, we take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised. Nonetheless, it was quite eye-catching, and we noticed that. We also noticed that the index of common inflation expectations at the board has moved up after being pretty flat for a long time. So we're watching that, and we're thinking, this is something we need to take seriously. And that is one of the factors, as I mentioned, one of the factors in our deciding to move ahead with 75 basis points today was what we saw in inflation expectations. We're absolutely determined to keep them anchored at 2%. That was one of the reasons. The other was just the CPI reading.
So if you saw a movement like that again, another tick up in inflation expectations, would that put a 75 or even 100 basis point increase in play at your next meeting?
You know, I'll just say we're going to react to the incoming data and appropriately, I think. So I wouldn't want to put a number on what that might be. The main thing is to get rates up, and then pretty soon we'll be in an area where we're, I think, as you get closer to the end of the year, you're in a range where you've got restrictive policy, which is appropriate. 40-year highs in inflation. We think that policy is going to need to be restrictive, and we don't know how restrictive. So I think that's how we'll take it.
Hi, Chair Powell. Neil Irwin from Axios. Thanks for taking our questions. The late-breaking kind of decision to go to 75 basis points, do you worry that will make policy guidance a less effective tool in the future? And should we think of that as a kind of symmetrical reaction function if we start to get soft readings on inflation, or if the labor market starts to roll over?
To take your second question first, yes. I mean, I think we're resolved to take this on, but we're going to be flexible in the implementation of it. Sorry, and your question was guidance. So again, the overall exercise is that we try to provide as much clarity about our policy intentions as we can, because we think that makes monetary policy work better. It's always a trade-off, because you have to live with that guidance. And so you do it, and it helps a lot of the time. I frankly think this year has been a demonstration of how well it can work. With us having really just done a very little in the way of raising interest rates, financial conditions have tightened quite significantly through the expectations channel, as we've made it clear what our plans are. So I think that's been a very healthy thing to be happening. So, and I would hope that it's always going to be any guidance that we give is always going to be subject to things working out about as we expect. And in this particular situation, we're looking for something specific, and that is progress on inflation. We want to see progress. We want to see inflation can't go down until it flattens out, and that's what we're looking to see. And if we don't see that, then that's the kind of thing that will cause. Even if we don't see progress for a longer period, that could cause us to react. But we will soon enough. We will be seeing some progress at some point. And we'll react appropriately to that too. But I would like to think, though, that our guidance is still credible, but it's always going to be conditional on what happens. This is an unusual situation to get, some data late during blackout, very close to our meeting. Very unusual to one that would actually change the outcome. So I've only seen, in my 10 years plus here at the Fed, I've only seen something like that, even close to that, one or two times. So I don't think it's something that'll come up a great deal.
Thank you so much for taking our questions. Colby Smith with the Financial Times. On the clear and convincing threshold for the inflation trajectory, what is the level of realized inflation that meets that criteria? And how is the committee thinking about the potential trade-off of much higher unemployment than even what's forecasted in the SEP if inflation is not moderating, at this acceptable pace?
Sorry, the second part I didn't get.
What's the potential trade-off with higher unemployment than even what's forecasted in the SEP if inflation is not moderating at an acceptable pace?
Right. So what we want to see is a series of declining monthly readings for inflation, and we'd like to see inflation headed down. So but, and right now, our policy rate is well below neutral, right? So soon enough, we'll have our policy rate. Let's assume the world works about like the SEP says. The policy rate will be up where we think it should be, and then the question would be, do you slow down? Does it make you, you'll be making these judgments about, is it appropriate now to slow down from 50 to 25, let's say, or speed up? So that's the kind of thinking we'll be doing, and we're looking. Ultimately, we're not going to declare victory until we see a series of these, really see convincing evidence, compelling evidence that inflation is coming down. And that's what I mean by, that's what it would take for us to say, okay, we think this job is done. Because we saw, and frankly, we saw last year, inflation came down over the course of the summer and then turned right around and went back up. So I think we're going to be careful about declaring victory. But again, the implementation of our policy is going to be flexible and sensitive to incoming data.
Are you more concerned now that to bring down inflation, it's going to require more than just some pain at this point?
So again, I think that I do think that their objective, and this is what's reflected in the SEP, but our objective really is to bring inflation down to 2% while the labor market remains strong. I think that what's becoming more clear is that many factors that we don't control are going to play a very significant role in deciding whether that's possible or not. And there I'm thinking, of course, of commodity prices, the war in Ukraine, supply chain, things like that, where we really can't. The monetary policy stance doesn't affect those things. So, but having said that, there is a path. There's a path for us to get there. It's not getting easier. It's getting more challenging because of these external forces, and that path is to move demand down, and you have a lot of surplus demand in take for example in the labor market. So you have two job vacancies essentially for every person actively seeking a job, and that has led to a real imbalance in wage negotiating. You could get to a place where that ratio was at a more normal level, and you would expect to see those wage pressures move back down to a level where people are still getting healthy wage increases, real wage increases, but at a level that's consistent with 2% inflation. So that's a possibility, and you could say the same thing about some of the product markets where there's just excess capacity, and where the strong demand has gone into where they're capacity constrained, right? So you have effectively what we think of as a vertical supply curve or close to it. So demand comes in and it's very strong, and it shows up in higher prices, not higher quantities, not more cars, because they can't make the cars because they don't have the semiconductors. So in principle, that could work in reverse. When demand comes down, you could see, and it's not guaranteed, but you could see prices coming down more than the typical economic relationships that you see in the textbooks would suggest because of the unusual situation we're in on the supply side. So there's a pathway there. It is not going to be easy, and again, it's our objective, but as I mentioned, it's going to depend to some extent on factors we don't control.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. So the new projections show the unemployment rate ticking up through 2024. Is a higher unemployment rate necessary in order to combat inflation? And what is lost if the unemployment rate has to go up and people lose their jobs in order to control inflation? Thank you.
So you're right. In the SEP, we have unemployment going up to the median is 4.1%. There are, of course, a range of actual forecasts, and I would characterize that if you were to get inflation down to, on its way down to 2%, and the unemployment rate went up to 4.1%, that's still a historically low level. We hadn't seen unemployment rates below 4% until a couple of years ago. We'd seen it for like 1 year in the last 50. So the idea that, 3.6% is historically low in the last century. So a 4.1% unemployment rate with inflation well on its way to 2%, I think that would be, I think that would be a successful outcome. So we're not looking to have a higher unemployment rate, but I would say that I would certainly look at that as a successful outcome.
Does that include people losing their jobs, or?
We don't seek to put people out of work, of course. We never think too many people are working and fewer people need to have jobs. But we also think that you really cannot have the kind of labor market we want without price stability. And we have to go back and establish price stability so we can have that kind of labor market. And that's a labor market where where workers are getting wage increases. Maybe the workers at the lower end of the spectrum are getting the biggest wage increases, as they were before the pandemic, where participation is high, where there's lots of job opportunities, where it's just the labor market we had before the pandemic that's what we want to get back to. And you see, disparities between various groups at historic lows. We'd love to get back to that place. But to get there, it's not going to happen with the levels of inflation we have. So we have to restore that, and it really is in service in the medium and longer term of the kind of labor market we want and hope to achieve.